tonight, you will see a live simulation of a National Security Council's Principals Committee meeting at the White House. Our scenario takes place 2 years from today, on November 19th, 2021. We have simulated a world in which one big thing has changed. In March 2020, the People's Bank of China launched a sovereign digital currency known as the digital yuan.
We're hearing reports that North Korea may be using China's digital yuan currency to evade sanctions and purchase weapons material.
Well, the digital yuan is an opportunity for the North Koreans to break free of the American hold on dollar transactions.
Have been leapfrogged by others, by digital currency, by digital Chinese currency. Why? Because, frankly, our central bank has been slow. And there's an appointment coming in January of 22. The president's got to decide whether to change over who's leading the Federal Reserve. The Federal Reserve runs our payment system. Right. And I think we need to move that Federal Reserve into the modern era.
Works up 6 or 7 or 8 alternative simulations, and they simulate, different things. It's not so much geopolitical events, though. It's more different ways the economy could play out. And we all the participants read those and think about them and talk about them, and they come up in our meetings. We talk about them. So it's very helpful because you can't get too focused on the modal path in a world where it's just very hard to predict the economy. Even in normal times, it's very hard to predict the economy, let alone times like today.
What sort of simulations do you talk about?
I'm going to leave that to your imagination.
I bet I can think of a few.
For core inflation, I don't see us getting to 2% this year or next year. I see us getting there the year after.
2025.
Yeah.
Core inflation 2%. So you're going to be restrictive for a long time.
No. We will be restrictive as long as we need to be. But if inflation is coming down sharply and we're confident that it's on a path to 2%, that would be a different situation. You would begin to think about loosening policy, but we're a long way from that. That's not something we're thinking about now or in the near future.
But you're not calling it a pause, and you're not calling it a skip. So what are we calling it?
Well, first of all, Sarah, thank you, and Christine, thanks for hosting us here in Sintra. So what we're calling it is maintaining the level of the federal funds rate at its current level for this meeting. Thank you. And we did that. If you think about it, we've raised the federal funds rate by 500 basis points since a little more than a year ago, and we think so. We've come a long way. We also think that there's more tightening power coming through. Really, policy hasn't been restrictive for very long. We started at negative real interest rates, and we've now moved up to where we actually are in restrictive territory, but we haven't been there very long. So we believe there's more restriction coming. And what's really driving it, to Andrew's point and Christine's as well, is a very strong labor market. We've got a labor market that, where jobs are being created, there's strong wage gains, and that's driving spending, driving real incomes and driving spending, which is driving more demand and continuing to drive labor market. So the labor market is really pulling the economy. And my colleagues and I, as you will know, wrote down in our SEP 2 more additional rate hikes. The median was quite a strong majority, actually wanted 2 or more rate hikes. And the reason for that was, if you look at the data over the last quarter, what you see is stronger than expected growth, a tighter than expected labor market, and higher than expected inflation. So that tells us that although policy is restrictive, it may not be restrictive enough, and it has not been restrictive for long enough. As you get closer and closer to the goal, what we're aiming for is a stance of policy that's sufficiently restrictive to bring inflation down to 2% over time. As you get closer to that, you get closer to the place where the risks become more in balance. So, we did 4 75 basis point hikes in a row starting in June of last year. In December, we moved down to 50. Then we did 3 consecutive 25 basis point hikes. So this is really just a continuation. We're going to move the decisions a little bit, make them a little bit with a little bit more time in between them, in an effort to get more information from the data to see how much restraint is really coming from these, through the pipeline from rate hikes that we only made now, in many cases, 6, 8, 9 months ago. So that's why we did it. We've not decided that. So the only thing we decided was not to raise rates at the June meeting. We have not made a decision to go to that. It may work out that way. It may not work out that way. But I wouldn't take moving consecutive meetings off the table at all.
And all these policies of your colleagues, the yen has gotten very weak and continues to weaken by the minute. Is it too weak?
Well, the yen is being influenced by many factors other than our monetary policy, including the policies of these three banks. So we'll see. We monitor the situation very carefully.
Monitoring the situation for intervention purposes.
No. It's the jurisdiction of the Ministry of Finance. Decisions on intervention.
Coming down is certainly welcome and ought to help keep inflation expectations anchored. But I think it actually helps to think about core inflation broken into three pieces. The first of which is goods inflation. And we've seen goods inflation coming down for 6 months now. And that's because supply chains are improving. The shortages are more or less gone, and also because consumption is moving back to services and away from goods. So that part of the story makes sense. Housing services is the next piece, and between that and goods, you have a little bit less than half of the total index. And you see now the new rents that are coming in are at lower increases or no increase, and so there's significant disinflation in the pipeline there, but it's going to take 12 months or 18 months to get there. The place where we haven't really seen much progress is in non-housing services, which is a little more than half of our core PCE inflation index, and that's hotel services, travel services, food service, financial services, healthcare, those things. It's a generally very labor intensive. Some of it's quite cyclical intensive, but some of it's not. The point is, that's where we're not seeing a lot of progress yet, and the reason is that, or one explanation for it is that labor costs are really the biggest factor by far in most parts of that sector, and so what we need to see, we've seen a lot of signs of softening in the labor market, but it's just kind of beginning. We need to see a better alignment of supply and demand in the labor market and see some more softening in labor market conditions so that inflationary pressures in that sector can also begin to subside.
Are you surprised that hasn't happened yet after 500 basis points of tightening already in a little over a year?
Yes, I think widely it's been surprising that inflation has been this persistent, but I think the bottom line is that policy hasn't been restrictive enough for long enough to start to see those effects. And the service sector is not especially interest rate sensitive, by the way, as opposed to, for example, the goods sector. So we wouldn't expect it to be the first to be affected, but we would ultimately expect, as demand softens and as the labor market conditions go more into balance between supply and demand, we would expect to see inflationary pressures subside in that sector as well. That there seems to be a path still for labor market conditions to soften and for demand and supply to get back into balance without the kind of large job losses that have happened in many prior cycles. And the reason for that is the level of job openings that still exist in the labor market. So it's still set 1.7 job openings for every person who counts as unemployed. That has been coming down. Actually, the number of job openings has come down now by almost 2 million. And what you're seeing wage pressures. They're still high, but they're definitely coming down. You're seeing surveys of workers and businesses suggest that the labor market is not as tight as it was a year or two ago. So you're seeing a job creation is beginning to come down. There are a number of indicia that would suggest that we're getting the softening that we need. We're getting it slower than we'd expected, but nonetheless, it's happening. So it's still a possibility there, but it's so uncertain right now that in my view, the least unlikely case is that we do find our way to better balance without a really severe downturn. I think there's a significant probability that there will be a downturn as well, though, but it's not to me the most likely case.
That's the hard landing scenario.
Or just this, I wasn't even thinking of hard landing. I was thinking of even a recession. To me, it's not the most likely case, but it's certainly possible. And of course, many forecasters do predict that. Quite resilient, and the data that we're still seeing, including since the last meeting, still is consistent with with an economy that's resilient and growing albeit at a modest pace. As I mentioned earlier, though, yes, there was no question. The first question was how fast should we go, and we went pretty fast, and we got to a level that we believe is restrictive. We're in restrictive territory. If you take the federal funds rate and you subtract some forward-looking measure of expected inflation, you'll get a significantly positive real rate, meaning we're probably in restrictive territory. So, and I think we have steadily slowed the pace of our moves, and it's appropriate to do so for one reason, because the more information we get, the better decisions we'll make. The risks of doing too much versus doing too little become more in balance. I wouldn't say they're in balance yet, but they're becoming closer to balance. I still believe and the committee clearly believes that there's more work to do, that there are more rate hikes that are likely to be appropriate, though.
So you think the risk is still of doing too little and not getting control of inflation?
Yes, and of course
But inflation expectations are, I don't have to tell you, very well anchored.
No, but the thing with the risks is that there may be social costs associated with restoring price stability. The social costs of failing to restore price stability will be higher in almost all likely cases. We've seen what that looks like, and it's just something that we have to do. It's the one of the principal things that society counts on us to accomplish, and I think we all feel committed to accomplishing it. It is of course a good thing that inflation expectations have remained anchored all this time, but our understanding of inflation expectations is not a precise one, and the longer inflation remains high, the more risk there is that inflation will become entrenched in the economy. So we have to, the passage of time is not our friend here. There are changes, and we don't know how persistent they will be. Certainly, work from home, and you can see the effect on commercial real estate, particularly office real estate and the surrounding retail that's suffering in many major cities. We don't know how long that will last. It feels like some part of that will be persistent and will last. You mentioned the data as well. I guess response rates to a lot of the data that we collect and that other organizations collect, the response rates have gone down, and you're seeing a lot of volatility in some of these data series. More so, I would say, more so than we've seen historically. So the data are even a little bit foggier than they usually are. But we'll be, in terms of what the effects of COVID, it's going to have long-term effects on the economy. There may be loss of productivity. There's certainly been, for a generation of kids, some loss of education and training. I think it's hard to say how persistent all this will be. But the way it lays out is the large banks don't have large concentrations of commercial real estate, so that's a good place to start. A surprisingly large part of exposure to commercial real estate is in the banks that are under 100 billion. But there, the worry is more banks that have a high concentration, and they're relatively few. So it's something that we're carefully monitoring. Bank supervision has a playbook for this. So supervisors are talking to banks about their concentration in real estate and what can they do and how do they manage themselves out of this. It's something that we're well aware of. It's not a surprise, and we're focusing on it.
Is it one of the reasons you were cautious in the last meeting?
Commercial real estate? I wouldn't say so. No, I just generally speaking, it was at the last meeting. It was about what's in the pipeline, how far we've come, what's in the pipeline. I will also say that the bank stress that part of the decision, in my thinking anyway, was the bank stress that we experienced earlier this year, there's a fair amount of research showing that when something like that happens, bank credit availability and credit can move down a little bit with a bit of a lag. So we're watching carefully to see whether that does appear. Of course, tightening in financial conditions is what we're doing intentionally. So we have seen bank credit conditions tighten. The question is, and that's what we're trying to achieve. The question is there another channel of that or a greater amount of that coming from what happened in March? We don't really see any evidence of that, but I think that's certainly in the back of my mind to see whether we do see that.
Yeah, it gets into the question about lags. How long are lags?
I would just say again, so what's different this time is actually, though, that markets move substantially in anticipation of moves. So by the time we lifted off in March of 2022, the 2-year had moved from 20 basis points up to 200 basis points. So financial conditions now move in expectation, and the whole modern communication strategy really helps that along. So that is different. What may or may not be different, and we also haven't had this kind of tightening in 3 decades. Really, we've had tightening, but it wasn't. This looks more like tightening cycles from the 70s and 80s. So what we see is a picture of literature that has, the older literature says, a year or two for activity and add a year for inflation. There's new literature that says it's much faster than that, and I think we just have to use our, to watch and see what's happening. There are beginning to be, there are reasons to argue that it would be faster this time or slower this time, but I just don't think we know at this stage.
Well, it kind of gets into the question about the markets, and you're saying that it's a transmission mechanism. You're all talking very hawkishly and saying there's more work to be done, and we're still worried about inflation. The markets pretty much think you're almost done. All of you guys. Maybe one more hike in July, and then done, and then into cuts next year. Is that wrong?
Participants on my committee on inflation, you'll see, we've been consistently thinking this is going to take some time. It's going to be a process that will take longer than we would have hoped. And it may well be a bumpy process, but markets have gone back and forth between pricing and what appearing to price in pretty quick declines in inflation to coming back to being more in alignment with the thinking of the committee. And that's where we are right now, is closer to where committee participants are. But as Christine said, we're not focused on what the market's forecast is. We have our forecast. All of us who are on the committee, we work hard to develop an understanding of what's driving inflation and what the path forward for inflation is. We make our best estimates. And that still is that it's going to take some time. It's just going to take some time. Inflation has proven to be more persistent than we expected, not less. And of course, if that day comes when that turns around, that'll be great. But we don't expect that. We don't plan for it.
So is it counterproductive to you that the stock market has rallied, the bond market has rallied? I mean, the market is fighting the Fed. The market thinks you're closer to the end, and I mean that does make financial conditions easier. You can't fight the Fed, but they're fighting the Fed. Is that a problem for you?
I don't see it that way. I don't look at it that way at all. Honestly, we have different jobs. Our job is to bring inflation down to 2% and sustain maximum employment. That's our job. That's what we think about. We look at the data, and that's what we care about. And markets react. Different parts of the market react in different ways. It's just not something that is a principal focus of our work.
But it did seem last year like you wanted a weaker stock market. You used the word pain at Jackson Hole. It seemed like you were trying to communicate that financial conditions should tighten, and less so this year. Is that right?
Not really, no.
Okay.
Of course, we work through financial conditions. That's what we do. Our rate and our all the things we do and say work through financial conditions to affect the real economy. That's how it works. But it's broader financial conditions. So we're not focused on any one market. We're never thinking, let's do this to this market. It's just in general, let's communicate what we want to do and why we want to do it. And financial conditions adjust. And that's really all we can do. We do not target particular parts of the market. Although, of course, we do monitor market conditions.
So you don't care what the stock market's doing?
I look at broader financial conditions. It's one of many conditions, along with interest rates, credit spreads, everything, all of the conditions and the availability of credit. It's one of many things. Again, we don't focus on any one thing as the key thing.
What do you think about the U.S.-China relationship as it impacts the economy?
We don't have any role to play in the relationships between the countries, but China's a very large, important economy. It's a big trading partner, mainly consisted of us buying things that are made in China. I don't think, and the Chinese economy came out of the COVID and looked like it was recovering strongly. Now it doesn't look like that. It looks like it's slowed down, and there's some issues there. From the U.S. standpoint, at the margin, that probably means a little bit less global demand. I wouldn't say it's a first order consideration for us, though.
How does Chair Powell reference the disappointing nature of the Chinese economic recovery? How does that play into us? If you think that the U.S. regional banks are resilient right now?
I do. So I think, first of all, the overall banking system is strong and resilient with very high levels of capital and liquidity, double the levels that they were at, and then some before the crisis. So the innovations that we put in place, the regulatory changes and higher capital, those are all in place in the United States as well. So when it comes to the events we had earlier this year with three banks that had pretty idiosyncratic business models and funding models as well. I think we need to learn lessons, and we're not hiding from that at all. We understand there going to need to be regulatory strengthening of both regulatory and supervisory practices as it relates to institutions of that general size, I would say.
You got a lot of questions on that from Congress last week.
That's mostly what they wanted to talk about.
They want to make sure that you aren't, well, in part, not going to increase capital levels and sort of choke off the small and regional banks in this country and make it hard for them to compete.
So the U.S. has something like 4,500 banks. It's the most banks by a pretty big margin, I think, of any major economy. And we think it's a real benefit to have banks of different sizes and business models that serve local communities and offer different products, as well as having the large banks. And the large banks in the United States are very strong, well capitalized, a lot of liquidity, and they've been a source of strength, I think, through the last couple of events. So I think it's important that whatever changes we do make, keep in mind the need to preserve the business models of these of smaller banks and not just of the largest banks.
Any concerns for you, Governor?
Our assignment is to deliver price stability, kind of regardless of the stance of fiscal policy, and we don't play a role, formal or informal, in advising the fiscal authorities. There are other agencies in Washington that do that, and that's really not our job. I will add, though, without crossing any lines, that the spending during the pandemic was very high, and it's come down. And so we look at the fiscal impulse from the level of spending, and it's really not material. It may even be slightly contractionary, but let's just say it's flat. You identified those bills, and I think you are seeing some of that money showing up in construction numbers. It's supporting construction activities, particularly the infrastructure bill. But I wouldn't say that that's if you look at where the inflation is in the economy, I wouldn't say that that's an important driver of inflation or something that we think about or consider.
So you mentioned the consumer. So the excess savings, you think have pretty much come down. Where do you think the U.S. consumer is headed? The consumer had savings from two sources. One was just the fact that people couldn't travel and couldn't kind of spend money on services. That was a lot of it. And there were also the fiscal transfers that happened. And those, there are many different estimates. I would say for people at the lower end of the income spectrum who tend to have a high marginal propensity to consume, most but not all of that money is gone. So there's certainly some residual support for spending in laws that passed at the beginning and during the pandemic. But that's, again, I wouldn't say that's today the main driver. I think if you look at the strength of the labor market, still creating more jobs than there are new entrants to the labor market, and wages are still pretty high. So you're driving up disposable income, and that is driving consumption, and that's driving the economy. We had hoped and expected it would work. We have a entirely passive program. As treasuries and mortgage-backed securities mature, they roll off subject to a cap, and it's been moving along at a pace. The underlying pace, if you hit the cap, is about $1 trillion a year. And reserves appear to be quite ample, so it has a ways to go. Is there anything that would make you speed that up or slow that down?
We always say that we're prepared to adjust in light of evolving conditions, but I don't see anything that would cause us to want to do that right now. We're just doing what everyone else is doing. We're trying to get smart about it, and it obviously has huge possibilities. Technologies tend to, propagate through the economy fairly slowly, and this one may be the exception, maybe not, I don't know. But it's something that we're spending a lot of time on, way too early for conclusions. I wouldn't use optimism, but I would say this in answer to your first question, which is when inflation first arrives, it's really due to very strong demand for goods and goods pipelines that just aren't working, and shortages. So that's where it comes from. It wasn't about the labor market at all, right? Or very much. As we get to this stage and looking forward, we think it will be significantly about getting the labor market, supply and demand, back in alignment. I would say it's a positive thing. I'll say it that way. It's a constructive thing that we've been able to raise rates 500 basis points with the expectation of going further, and we still have a very strong labor market, but nonetheless one that is in fact cooling in just the way we would have hoped, which is to say through things like lower job openings. Job openings are coming down. The quits level has returned to its pre-pandemic level. wages have, if you look at employment compensation index or average hourly earnings, they've moved down about 1% towards more, still very high, but towards more, so a more sustainable level that's consistent with 2% inflation. So I would just say that's the makings of, if that process continues in a gradual way without really any effect on employment, the longer that goes on, the better. And in a way, I take that as a very constructive path. It is not guaranteed, but the fact that this is really there, and that's what's been happening for a year, more than a year into our tightening cycle, I would take as a positive thing and perhaps a hopeful one for the future.
Welcome to the Crypto Teacher. And you know I come back with that video just to make you think.
Don't forget to like and subscribe to the channel.
And guys, we have the central bank forum. And we know the central banks are moving in lockstep. And this forum was clearly all rehearsed. But again, we had Jerome Powell not telling us the whole truth. We can clearly see the central bank's plan. We know we are in a simulation. Now, Jerome Powell says that inflation won't hit 2% until 2025. And guys, what did I tell you? They're going to flip the fourth industrial revolution switch in 2025. But we're definitely going to get below 2% before 2025. We can already see the consumer drowning in debt. Only thing you have to do is go to the Fed's data. And it was interesting, Jerome Powell brought up the C word and talked about how it hurt the kids' education. And we know the Fed has the data. Now, Jerome Powell also stated the labor market is good, which we know is not the truth. He also stated that the banks are in good condition, which we know is definitely not the truth. That's the reason why they want to consolidate all these regional banks, and we know what comes next. Small businesses fall by the wayside, and then you have mass layoffs. But we know the NWO caused the problem, wait for the reaction, and run in with the solution. And we had Japan's central bankers say it all. The major central banks are affecting his economy. We know Japan is still in negative interest rates because they hold a lot of the United States debt. But this is also part of Society 5.0, the fourth industrial revolution, going through hyper-deflation caused by the robots, algorithms, and drones that replaces humanity in the workforce. And we know during the C word, it was already tested how the people are going to react when it comes to sitting at home getting free money. And we know the NWO has just the solution. Airdrop that free money. They have 3 to 6 months to spend it, or poof, it's gone. Programmable money telling you what, where, and when and how to buy. And remember, the Crypto Teacher told you, because he knows when it comes to the New World Order, it's all planned out. You have a wonderful day.
But every stock, every bond, every currency, every commodity, every piece of art, every private business, every piece of real estate will eventually be a token on a blockchain, an entry on a ledger, permanent and immutable. We will have truth instead of trust, and we will save over $7 trillion a year. 6 to 8% of global GDP is wasted by the friction of the trust industry that's necessary when you have dual entry accounting. With triple entry accounting, which is what a blockchain is, we get rid of all of that friction. It's a beautiful future.
I actually believe this technology is going to be very important. Look at it. We have been part of a huge revolution in investing through ETFs. We believe that ETFs will be changing the whole way we invest. Many people still use it as a means, well, people are investing it for indexing. No, the majority of people who are putting money in in ETFs are active investors that are buying exposure. The entire bond market is being transformed as we talk right now. I believe the next generation for markets, the next generation for securities will be tokenization of securities. And if we can have that distributed ledger that we know every beneficial owner, every beneficial seller, we all have our code of who's buying, who's selling, instantaneous settlement. And think about it, it changes the whole ecosystem.
Going to a different economy, and we're going to be learning more about that as we go. But clearly, we're learning that things can be done from remote locations. We're learning that technology can replace people even more than we thought.
We're not going back to the same economy. We're recovering, but to a different economy, and it'll be one that is more leveraged to technology. And I worry that that is going to make it even more difficult than it was for many workers.
In Silicon Valley, and my friends who work in technology know that what we did to the manufacturing workers, we are now going to do to the retail workers, the call center workers, the fast food workers, the truck drivers, and then even bookkeepers, accountants, insurance agents, lawyers, and on through the economy. So what happened to the manufacturing workers is a very clear sign.
And so we'll import Chinese-based CBDC technology. So it's going to be CBDC in a box provided to you by the People's Bank of China.
Cryptoteacher and the New World Order book, plus the 3 kids books. It's time to re-educate. Also, new to cryptos, Coinbase, Bitrue, Binance. Do not forget book links and crypto links are in the description. The stock channel, guys. Don't forget to go like, subscribe, spread everywhere. You have your Kobo, your chip stocks, your banking, your gaming. While everybody's sitting at home, get on stocks, the Seaver, the biotech stocks. And while everybody's at home wishing they were still getting that free money, what are they doing? Drinking and smoking weed. Don't forget about those stocks, and you have a wonderful day. The most powerful person in the world is the storyteller. The storyteller sets the vision, values, and agenda of an entire generation to come. Steve Jobs. And guys, you know I truly believe in this. When you look at the New World Order, they're the storytellers. And that's the reason why I wrote my New World Order book. But guys, now it's time to change the current generation. And I wrote 3 kids books. You know I love the Trinity because I understand the power that's in it. So I have 3 books. We have an opportunity to change the generation, to educate. Not just me, but I want to show you that I take action on a daily basis. And I want you to take action on a daily basis. Whether it's your job, whether it's in your community, we have an opportunity right now to educate the masses. I posted this on my Twitter account. Please share, but this is a short clip of the 3 books. There's going to be a clothing line and action figures. Please get these books for your kids, nephews, cousins, friends, so therefore we can start the re-education now. Because as we see, the 4th Industrial Revolution foundation is definitely here. Robots, algorithms, drones, taking humanity out the picture. We have to re-educate. But let's get into the video.
Part 1. King Joshua and Grandma Tam save the village. Part 2. King Joshua and Grandma Tam save New York from COVID-33. Part 3. King Joshua and Grandma Tam goes to China.
It's mandatory to get part 1, part 2, and part 3 of this series. It's time to re-educate Generation Z.